So I deeply regret not knowing this before I started saving for retirement. When I was in my 40s, I built my whole retirement plan around a number I trusted completely. It turns out the number was never meant to be a rule. And there's a 99% chance you're using it right now. Because if you're planning to retire on 4% withdrawals, and most people are, you could be heading toward a downfall and run out of money sooner than you think. So before we talk about what to do instead, let's understand where this number actually came from. To understand why this rule is failing us today, we have to look back in the world it was born in. Because the world of 1994, it doesn't exist anymore. For decades, this so-called rule dominated retirement planning. You've probably heard about it before. Withdraw 4% of your savings, adjusted for inflation every year, and your money should last for about 30 years. But recently, financial experts have started saying something surprising. It does not work anymore. And when people hear that, they often panic. Because if the rule doesn't work, then what exactly are we supposed to do? But here's the interesting part. The real problem isn't that the rule stopped working. The real problem is that it was never meant to be a rule in the first place. And understanding this completely changes how you think about retirement. If you've been thinking a little too much about money lately, this channel is for you. Because here in the long view, we step back from the noise and look at money through a calmer lens. In this video, we're going to talk about the famous 4% rule, why so many experts say it no longer works, and more importantly, what calm investors should do instead. Because the real lesson here is that the 4% rule didn't come from social media. It didn't come from financial influencers. And it didn't come from headlines. It came from research. In 1994, a financial planner by the name of William Bengen studied historical market returns. He looked at data going back to 1926, which means he sat down and did math about other people's math. And he asked a simple question. If someone retired and withdrew money every year, how much could they safely spend? His conclusion was surprisingly simple. Start withdrawing about 4%, then increase that amount every year with inflation. And historically, that strategy worked most of the time. Now later, the famous Trinity study tested similar scenarios, and it reached a similar conclusion. A balanced stock and bond portfolio could support about a 4% withdrawal for about 30 years. And that's how the number became famous. But here's the important detail. It was never meant to be permanent advice. It was simply a historical observation, a footnote that somehow became a bumper sticker. Now, here's the surprising part. The 4% rule hasn't actually changed, but the world around it has. And that matters because retirement today looks totally different than retirement 30 years ago. So let's take a look at it. First, people are living longer. Many retirees today may need their money for another 35 years or even 40 years, which is a long time to trust a number someone wrote down in 1994. And that changes the math. Because the longer the timeline, the more market volatility matters. But here's another issue. Future market returns may be lower. Stock valuations today are higher than average. And historically, high valuations often lead to lower future returns. At the same time, bond yields are lower than they were in the past, which means bonds may provide less support to retirement portfolios. And here's another problem. The 4% rule is rigid. It assumes something unrealistic, that retirees spend the same inflation-adjusted amount every single year, no matter what markets do, no matter what life does, as if retirement was a spreadsheet and not an actual human life. Now, here's something many people don't realize. The biggest risk in retirement isn't actually the withdrawal rate. It's timing. Because if markets fall early and you continue withdrawing the same amount, your portfolio can shrink very quickly. This is known as sequence of returns risk, and it can quietly damage the retirement plan, especially in the first decade. But here's the interesting thing. Many retirees, they don't behave that way. When markets fall, people naturally spend less. They delay travel. They postpone large purchases. They eat at home and call it a lifestyle. And that flexibility changes everything. So, what are many planners suggesting now? Something surprisingly simple: flexibility. Instead of rigid rules, they recommend adaptable systems. For example, if the portfolio grows strongly, they allow spending to rise slightly. But if markets fall, they temporarily reduce withdrawals. Others, like myself, use a bucket strategy: cash for near-term spending, bonds for stability, stocks for long-term growth. And this approach creates something important: time. Time for markets to recover. Time for portfolios to grow. Time for investors to stay calm. But here's the key insight: the real goal is not finding the perfect number. The real goal is creating a system that you can live with for decades. Look, the 4% rule was never a promise. It was never a guarantee. And it was never meant to control your retirement. It was simply a starting point, a rough guide, a simple framework to begin thinking about spending. And when people say the 4% rule is broken, they're missing the bigger picture. Because the real lesson was never about the number. It was about flexibility. And calm investors already understand this. Because retirement is not a formula. It's a long series of decisions, made slowly, adjusted gradually over many years. So the next time you hear someone say the 4% rule doesn't exist anymore, remember this: the rule didn't fail. It simply revealed something deeper. Good retirement planning was never about rigid rules. It's about thoughtful systems and the ability to adjust when life changes. Because in the end, retirement success isn't about perfect math. It's about staying calm, staying flexible, and keeping the long view. I'll see you next time.